If banks froze tomorrow, you wouldn't lose your money. You would lose access to it. And that difference, between losing money and losing access, is where the real power of the financial system hides. Because the number in your bank account is not cash sitting in a vault with your name written on it. It is a digital entry, a recorded liability, a claim inside a layered financial structure that only functions if trust, liquidity, and confidence continue moving without interruption. Modern banking does not store money the way most people imagine. When you deposit funds, the bank does not seal it in a box and wait for you to return. It integrates that deposit into a balance sheet. It becomes part of a lending engine, a credit creation system, a network of obligations stretching far beyond a single branch or institution. Your deposit becomes fuel. Banks operate on fractional reserves. They keep a portion of deposits available and use the rest to issue loans, purchase assets, and expand credit. This system increases economic growth. It multiplies activity. It allows economies to expand far beyond the physical currency in circulation. But it also creates structural dependence. If every depositor requested their funds simultaneously, the system could not respond. Not because money disappeared, but because it was never sitting idle in the first place. This is not a flaw hidden in the shadows. It is how modern finance was designed. And design reveals itself during stress. When liquidity tightens, when confidence wavers, when rumors spread faster than official statements, the architecture becomes visible. In 2013, during the financial crisis in Cyprus, banks froze withdrawals. Large depositors saw portions of their accounts converted to stabilized institutions. Access was restricted. Transfers were halted. The system did not collapse entirely, it paused. And that pause changed everything. In other countries facing banking panics, withdrawal limits were imposed. Capital controls were introduced. ATMs ran empty. Not because vaults were completely empty, but because institutions needed to prevent acceleration. Because in finance, speed amplifies instability. The modern system moves faster than any system in history. Digital transfers occur instantly. Markets react in milliseconds. Information spreads globally in seconds. And panic, once digital, requires no physical line outside a building. A notification is enough. The global banking network is deeply interconnected. Banks lend to one another overnight. Institutions rely on short-term funding markets. Corporations depend on revolving credit facilities. Governments depend on bond markets to finance operations. Every major player is linked through layers of exposure. When trust declines in one area, liquidity tightens elsewhere. When liquidity tightens, asset prices fall. When asset prices fall, balance sheets weaken. When balance sheets weaken, fear spreads. The system runs on confidence more than currency. Central banks act as stabilizers. They inject liquidity during crises. They purchase assets. They lower interest rates. They expand balance sheets to prevent cascading failures. This has prevented systemic collapse multiple times in modern history. But each intervention increases dependency. The more markets expect rescue, the more risk accumulates beneath the surface. Leverage builds quietly during stability. Debt levels rise across households, corporations, and governments. Growth becomes reliant on continuous credit expansion, and continuous expansion requires continuous trust. In a world where cash usage declines and digital payments dominate, access becomes entirely infrastructural. Your salary is deposited electronically. Your savings exist digitally. Your purchases clear through payment networks. Your investments are held in custodial systems. Convenience replaces tangibility. But when access is digital, restriction can also be digital. Accounts can be frozen instantly. Transfers delayed automatically. Withdrawal limits imposed without physical interaction. Systems can restrict movement faster than individuals can react. Most people never consider this possibility because stability feels permanent, until it isn't. Modern economies are optimized for efficiency. Supply chains operate with minimal slack. Banks operate with calculated leverage. Companies operate with thin cash buffers, relying on credit markets for flexibility. Efficiency reduces cost. It also reduces resilience. When disruption occurs, whether financial, geopolitical, or technological, the system must absorb shock without breaking trust. If trust erodes, participants withdraw. And withdrawal, even rational withdrawal, accelerates instability. Liquidity is not about how much money exists. It is about how easily it can move. And movement depends on confidence. The average account holder sees a number on a screen and assumes ownership equals access. But ownership in modern finance is layered. You hold a claim against a bank. The bank holds assets financed by liabilities. Those assets are influenced by market valuations, interest rates, and broader economic conditions. Behind every simple balance is a complex web. The more interconnected the web becomes, the more efficient it grows. But interconnected systems share vulnerabilities. When everything is connected, stress in one node can propagate through the entire network. History shows that crises rarely begin with visible collapse. They begin quietly, in funding markets, in subtle increases in borrowing costs, in small shifts in credit availability. By the time headlines emerge, structural adjustments are already in motion. And once access becomes conditional, perception shifts permanently. You do not need total systemic failure to feel financial fragility. A temporary freeze, a short-term capital control, a precautionary restriction. These are enough to redefine the meaning of ownership. Because modern wealth is less about possession and more about permission. Permission granted by systems, by institutions, by infrastructure, by regulatory frameworks. The shift toward more centralized digital financial tools, including potential central bank digital currencies, increases efficiency and traceability. It may reduce fraud and improve policy response, but it also increases central coordination. When coordination increases, discretion increases, and discretion changes the balance between control and access. This does not mean collapse is imminent. It means stability is conditional. The financial system has survived wars, depressions, oil shocks, market crashes, and global pandemics. It adapts. It reforms. It expands. Each crisis reshapes regulation and policy. Each reform increases complexity, and complexity hides both strength and fragility. When you check your balance, you see a number. Behind that number are lending markets, central bank policies, global capital flows, sovereign debt structures, and counterparty agreements layered across institutions. It works because trust works. But trust is psychological as much as structural. If enough participants question stability, behavior changes. Withdrawals increase. Asset sales accelerate. Funding tightens. The architecture is forced to respond. Speed defines modern instability. In previous centuries, panic required physical presence. Today, panic travels at network speed. Liquidity can evaporate digitally. Restrictions can be implemented digitally. Confidence can deteriorate globally within hours. You don't need a dramatic collapse scenario to experience disruption. You only need temporary friction. Payroll delayed for a week. Credit lines frozen. Transfers held for review. Market trading paused for stability. Each measure can be rational from an institutional perspective. Each measure can feel destabilizing from an individual perspective. And in that gap, between institutional stability and personal access, lies the real tension of modern finance. Your money is secure as long as the system remains fluid, as long as obligations roll forward, as long as markets clear, as long as institutions trust one another. That is a powerful system. It is also a delicate one. Because what you truly hold is not paper currency in a vault. You hold access to a network that must continuously function. When that network operates smoothly, modern finance feels invisible and reliable. When it hesitates, even briefly, its structure becomes visible. And once you see the structure, you understand something critical. Wealth in the modern world is not only about how much you have. It is about whether the system recognizes your claim in real time. If recognition pauses, access pauses. If access pauses, ownership feels theoretical. The global banking system is resilient, adaptive, and historically durable. But it is not immune to stress. It is not beyond intervention. It is not detached from human psychology. It runs on confidence. Confidence runs on perception. And perception can shift faster than liquidity can respond. Banks do not need to collapse entirely to freeze movement. They only need to protect themselves during instability. And when institutions protect themselves, individuals experience restriction. The difference between money and access is subtle, until it matters. Because when the system pauses, even briefly, the question is no longer how much you saved. The question is whether you can reach it. And in a world where everything is digital, interconnected, and leveraged, access is the true currency.